Hi everyone, today we'll be going over accounts October-November 2020 paper 3-1 question number 1. This is structured paper 3 which consists 6 questions each of 25 marks and we are also given a time limit of 3 hours. So we will be attempting to solve each question under 30 minutes. And this question number 1 is a part of section A which deals with financial accounting. Now without any further delay, let's get started. Barry owns a manufacturing business. He applies a rate of factory profit which varies each year. Okay, so this is not a constant factory profit rate. In this way, inventory is valued at a transfer price similar to the price at which the goods could be bought from an external supplier. Okay, so if he applies a rate of factory profit which varies each year, then it reflects the market price of his manufactured goods. Okay, then Barry provided the following information. Let's have a look at our first question. We need to calculate the amount of unrealized profit included in inventory on 31st December 2019. Alright, let's have a look above. We can see that we're given the opening dates information regarding inventory of finished goods at transfer price and the unrealized profit included in inventory value. So if we were to given an information stating that the rate of factory profit is constant each year, then we could have used this information, figured out our factory profit rate, and apply the same rate to this current year's inventory of finished goods at transfer price, right? But we were explicitly told that the rate of factory profit varies each year, so we cannot figure out our closing unrealized profit included in the inventory value by this method. So we must be given some information regarding whether there was an increase or decrease in the unrealized profit included in inventory value for this particular year. Let's have a look at our information. We are given prime cost, decrease in work in progress, revenue. Right here, we're given decrease in provision for unrealized profit, and it amounted to 15,000. So what this means is that our closing provision for unrealized profit is 15,000 less than the opening unrealized profit included in inventory value because there is a decrease. If it were to be an increase, then we would have added this 15,000 to our opening unrealized profit in order to figure out our closing unrealized profit included in inventory value, right? So we can easily figure it out. Let's write it down. Okay. So we will start with our opening inventory value, right? So let's have a look above. We can see that the unrealized profit included in inventory value at the date of 1st January 2019 seems to be 40,000. So we just need to subtract this decrease of 15,000 from our opening unrealized profit of 40,000. Let's do that. So that's going to be 40,000 minus 15,000, which results in the value of 25,000. This completes the first part of this question. Now we can move towards the second one. We need to calculate the rate of factory profit being applied in 2019. So what we know is that the formula for the rate of factory profit is just the unrealized profit. And we're talking about our closing inventory, right? So unrealized profit divided by our cost of inventory times 100%. Okay, and we already figured out our unrealized profit for the year ended 31st December 2019 to be 25,000. So we can just substitute that value. Okay, now for the cost of inventory, let's have a look above. We can see that we're given information regarding the closing date at 31st December 2019 right here. And we're given that the inventory of finished goods at transfer price was 125,000. So since this is a transfer price, this is going to include the cost as well as our unrealized profit, right? And this is 125,000. But in our formula for figuring out the rate of factory profit, we require the cost rather than the transfer price. So let's figure it out. We need to find out the cost, and we just figured out our unrealized profit for the first part of this question to be 25,000. Okay, now this is a very simple equation. We can easily figure out our cost of inventory. That is going to be 125,000 minus 25,000, which results in the value of 100,000. So let's substitute this value into our formula. So divided by 100,000 times 100%. Now this gives our rate of factory profit being applied in the year 2019 to be 25,000 divided by 100,000 times 100%, which results in the rate of 25%. This concludes the second part of this question. Now we can move towards the third one. We need to prepare income statement for the year ended 31st December 2019. Alright, so we are preparing the income statement for Barry. And this is the income statement for the year ended 31st December 2019. So whenever we're talking about income statement, we always start with our revenue. Let's have a look above. We were given the value for revenue. Alright, it's right here. And this amounted to 1,550,000. Let's write it down. So that's 1,550,000. And the next step would be to subtract our cost of sales, right? So that's less cost of sales. And we will always start with our inventory at 1st January 2019. So that's going to be our opening inventory. Let's have a look above. And since we're talking about a manufacturing business, the opening as well as the closing inventory should be valued at a transfer price. So we're given our opening inventory right here at a transfer price, right? And this amounted to 140,000. So let's substitute this value. That is 140,000. And if it were to be a normal business, then we would have added our purchases. But since we know we're talking about a manufacturing business, we require our transfer value, right? And this is the transfer value or the transfer price from our manufacturing account. So let's have a look above. Okay, so we do not really have the transfer value given explicitly, but we can see that there is prime cost, decrease in work in progress, and these two belong to the manufacturing account, right? So we need to prepare our manufacturing account in our workings and then figure out the transfer value and then substitute that value into our income statement. Okay, so these two are a part of manufacturing account. Then we have factory overheads, which is again the part of manufacturing account itself. And yeah, I think that's it. So let's figure out the total. So we can start with the prime cost, and we are given the prime cost total of 505,000. Then we can move towards the indirect cost, which is the factory overheads in this case, which amounted to 283,000. Let's write it down. And then we are given that there was a decrease in work in progress, and this amounted to 12,000. Okay, so if we remember the format of our manufacturing account correctly, after these two, prime cost and the indirect cost, we then add the opening work in progress and then subtract the closing work in progress, right? So if we know that our work in progress or the closing work in progress has decreased by 12,000, then suppose that our opening work in progress had the value of y, then our closing work in progress will have the value of y minus 12,000, right? Because that's the amount decreased from the opening in order to receive our closing work in progress. So we need to subtract this now. And that is just going to be y minus y plus 12,000, because this is a negative and two negatives result in a positive. So this results in the value of positive 12,000, right? So this just means that the decrement in work in progress means that we need to add that value in our manufacturing account. So let's add the 12,000. Now let's figure out the total. This is going to be the total cost of production. So that's the sum of these three values, which is 505,000 plus 283,000 plus 12,000, which results in the value of 800,000. Okay, then in order to figure out our transfer value, we now need to add the factory profit, right? And we figured out our rate of factory profit for this particular year in the second part of this question. Let's have a look. We figured it out to be 25%. So we're just going to add the factory profit, which is going to be 25% of our cost of production. So that's 800,000 times 25%, which we can write down as 0.25, which results in our factory profit to be 200,000. Let's add it. And this will now give our transfer price or transfer value. So that's the sum of the cost of production as well as the factory profit, which is 800,000 plus 200,000, which results in the value of 1 million. Now we will substitute this value into our cost of sales section of the income statement. Let's do that. Okay, so we have the transfer value of 1 million. All right, then the next step would be to subtract the closing inventory. So that's less inventory at 31st December 2019. And again, like I said before, since we are talking about a manufacturing business, these inventories should be valued at a transfer price. Let's have a look above. We can see that the inventory of finished goods at transfer price is given right here at the date of 31st December 2019, and this amounted to 125,000. So let's substitute this value into our income statement. That is 125,000, and we need to subtract it, so I'm just going to put it in bracket. Now this will give our total cost of sales. Let's do that. That's the sum of these three amounts. So that's 140,000 plus 1 million minus 125,000, which results in the value of 1,015,000. Okay, so since we need to subtract our cost of sales from revenue, I'm just going to put it in a bracket. Now we can easily figure out the gross profit. And gross profit is just the difference between revenue and our cost of sales. So that's going to be 1,550,000 minus 1,015,000, which results in the value of 535,000. Okay, then the next step would be to add back our factory profit, because we know that the transfer value consisted of factory profit, right? And this is being subtracted under the cost of sales. So we need to add back our factory profit. Let's do that. And we figured out our factory profit above. So let's have a look. Our factory profit amounted to 200,000. Let's substitute this value. So that's 200,000. Now we need to look for any other incomes that we need to add to our gross profit. Let's have a look above. Okay, we can see that there is a decrease in provision for unrealized profit, and we know that the increment in provision for unrealized profit would be treated as an expense, which means that the decrement in provision for unrealized profit should be treated as an income. So we need to add this amount of 15,000 to our gross profit. Let's do that. So that's a decrease in provision for unrealized profit, and this amounted to 15,000, so we're just going to add it. Okay, that concludes all of our income. Now we move towards our overhead section, and we need to subtract all of our overheads from the gross profit in order to figure out our profit from operations. So let's have a look above. We already included these two. We included the revenue, we included decrease in provision as well as the factory overheads. Now our overheads to be included would be distribution costs and administrative expenses. We know that finance charges is also an expense, but we will only subtract this from our profit from operations. So let's subtract our distribution cost first, and this amounted to 212,000. Let's do that. So that's a distribution cost of 212,000. Okay, let's have a look above again. Then the second one was administrative expenses, which amounted to 484,000. Let's write it down as well. So that's administrative expenses amounting to 484,000. And we know that this concludes all of our overheads, so we can just figure out our total. That's going to be the sum of these two amounts, which is 212,000 plus 484,000, which results in the value of 696,000. And since we need to subtract this, I'm just going to put it in a bracket. Okay, now we can easily figure out our profit from operations. And that is going to be the sum of these four amounts. So that's 535,000 plus 200,000 plus 15,000 minus 696,000, which results in our profit from operations to have the value of 54,000. And the next step would be to subtract all of our finance charges in order to find out our profit for the year. Let's have a look above. Okay, we can see that our finance charges amounted to 20,000. Let's substitute this value. That is 20,000, and since we need to subtract it, I'm just going to put it in bracket. And this will result in our profit for the year. And this will be the sum of these two values, which is 54,000 minus 20,000, which results in our profit for the year to be 34,000. Alright, this concludes the income statement as well as the third part of this question. Now we can move towards the fourth one. Okay, we were given our working section right here. So instead of scribbling all over the question paper like I did, you guys should be showing all of your workings in this particular box. We can see that we were given additional information. The factory manager has suggested that a rate of factory profit of 50% should be applied every year. And currently, we know that there is no fixed rate of factory profit, and this rate varies every year. So instead of doing that, the factory manager now suggests that there should be a constant rate of factory profit of 50%, which should be applied every year. And for the fourth part of this question, we now need to advise Barry whether or not he should apply a rate of factory profit of 50%, and we need to justify our answer. Okay, what we know is that the previous varying rate of factory profit was due to the fact that that particular rate would reflect the market price, right? So now changing our rate of factory to 50% constant every year, that would definitely not reflect the market price, and therefore it would be subjective. Let's write it down. This change in the rate of factory profit will not reflect the market price, and therefore would be subjective. Similarly, we know that currently our rate of factory profit is 25%, so increasing our rate of factory profit to 50% would definitely increase our factory profit. Let's write it down. This would increase the factory profit. And an increased factory profit would definitely reduce the gross profit, right? Because as we can see above, we are subtracting the factory profit as a part of cost of sales from revenue. So higher the factory profit, the lower will be our gross profit. Let's write it down as well. This would reduce the gross profit. And what we also know is that applying a constant rate of factory profit each year would be consistent, right? So let's write it down. A fixed rate would be consistent year on year. And this would also avoid large fluctuations in the provision for unrealized profits, since we are applying a constant rate of factory profit each year, right? Let's write it down as well. And would avoid large fluctuations in the provision for unrealized profit. Alright, now based on these factors, we now need to advise Barry whether or not he should apply a rate of factory profit of 50%. So solely on the fact that 50% would not really reflect the market price, right? So this can definitely drive up our revenue higher, which means that we could possibly lose our customer base as well. So due to that particular reason, I would suggest that he should not apply a rate of factory profit of 50%. Let's write that decision clearly. Barry should not apply a rate of factory profit of 50%. Alright, this concludes the fourth part of this question. Now we can move towards the fifth one. We need to explain where carriage on raw materials is recorded in the financial statements of a manufacturing business. Okay, so this is definitely recorded in the manufacturing account, right? Let's write it down. In the manufacturing account. And in the manufacturing account, we record our carriage on raw materials within the cost of raw materials, right? So that's within the cost of raw materials. Okay, so this concludes the fifth part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.